Welcome back. If you've been watching the property market lately, you know exactly what the vibe is. It's frantic. It's hot. You think, I need to enter the market now. So, you get your deposit together, you put on your best suit, metaphorically speaking, and you march into the bank. You're confident. You have a decent income. Your debts aren't crazy. But then, reality hits. You sit down with the lender, they run the numbers, and they come back with a figure that is, well, it's underwhelming. It's not enough to buy the house you want. You discover that your borrowing capacity is nowhere near what you imagined. It's a shock, right? You think, my income is good, my liabilities are low, what's going on? The truth is, the way you see your finances and the way a bank sees your finances are two completely different things. Today, we're going to bridge that gap. I'm going to share a roadmap on how to boost your borrowing power, your serviceability. We're going to start with the basics, the stuff some of you might already know, but then we're going to go deep into the insider strategies. The stuff usually only mortgage brokers and bankers know. So, grab a coffee, maybe a notepad, and let's dive into how to unlock the money you need. Part 1. The low-hanging fruit, personal liabilities. Let's start with the obvious stuff. If you want to borrow more, you need to look like less of a risk. The first step in this process involves a serious audit of your personal debts. 1. The way to personal debts, it sounds simple. Reduce your personal debt. We know that the more debt you have, the less you can borrow. But I want you to understand why and how much it impacts you. When we talk about debt, we're talking about personal loans, those tempting interest-free store finance deals for furniture or electronics, and the big one, car loans. Car loans are absolute killers for mortgage applications. You might look at a $500 monthly car payment and think, I can afford that in a mortgage. But the bank looks at that $500 commitment, and through their calculator, it might reduce your borrowing power by $50,000 or even $80,000. It's not a dollar-for-dollar reduction. It's exponential. So, before you apply, look at your car loan. Can you pay it off completely? If you can't pay it off, can you refinance it to extend the loan term? I know, nobody wants to be paying off a car for 7 years. But if extending the term lowers your monthly obligation, it increases your serviceability for the house. You can always pay the car off faster later, but for the application moment, lower monthly commitments are king. And if you already have a mortgage, look at the rate. If you can refinance that existing mortgage to a lower rate, you free up cash flow, which again, pleases the bank. 2. The credit card trap now. Let's talk about the silent assassin of borrowing capacity, credit cards. I have so many friends who carry multiple cards. They'll have an Amex for points, a Visa for travel, and a backup MasterCard just in case. They tell me, it's fine, I pay them off in full every month. I never pay interest. Here is what you need to understand. The bank does not care that you pay it off every month. The bank does not care if the balance is zero. When a bank assesses your application, they look at the limit, not the balance. If you have a credit card with a $10,000 limit, even if you've never spent a cent on it, the bank assumes you could max it out tomorrow and run away to Mexico. They treat that $10,000 limit as a $10,000 debt. Because credit card interest rates are so high, which usually can reach 20% or more, the bank applies a harsh calculation to that limit. A $10,000 limit might reduce your home buying power by $40,000 or $50,000. It significantly impacts your ability to borrow. So the strategy here is ruthless. Cut them up. Unless it is absolutely necessary, reduce the number of cards you hold. If you must keep one, call the bank and lower the limit. Do you really need a $20,000 limit? Or will $2,000 suffice? Every dollar you shave off that limit is borrowing power putting back into your pocket. Part 2. The income equation. Moving on to the other side of the ledger, income. 3. Boosting the top line. This third method sounds like a cliche, but it is the most direct way to solve the problem. Increase your income. This isn't just about asking for a raise, though that helps. It's about structuring your life to show more cash flow. This could be picking up a second job, doing casual work, or clocking in serious overtime. But here is the nuance. Not all income is created equal. Banks love stability. If you take a second job, you need to show consistency. If you have passive income, maybe dividends or a small side hustle, make sure it's documented. High-yield investments or passive income streams are excellent because they boost your serviceability without necessarily adding to your 9 to 5 grind. But remember, the bank needs to accept this income. We'll talk a bit later about how different banks view overtime and bonuses differently. But for now, just know, more documented income equals a bigger loan. 4. The power of joint purchases. If you've maxed out your income and minimized your debts, and it's still not enough, you might need a teammate. This brings us to method number 4, joint purchasing. This is very common in Australia and other high-price markets. If your single income isn't cutting it, you find someone who has income to spare. Traditionally, this is a spouse. But more and more, we are seeing people team up with siblings, cousins, or best friends to buy investment properties together. It instantly doubles the borrowing power. However, and this is a massive however, you need to be careful. You're mixing money with relationships. You need to consider the future legal responsibilities. What happens if one of you wants to sell and the other doesn't? What happens if one of you loses your job? Before you sign a contract with your best mate, go see a lawyer. Get a co-ownership agreement drawn up. It's not about mistrust. It's about protection. Part 3, the insider strategies beyond the big banks. Okay, so those are the basics. Reduce debt, cut credit cards, earn more, partner up. Now I want to shift gears. I want to share the stuff that the banks don't necessarily advertise. This is where a good strategy can outperform a high income. The loyalty tax, many of us are creatures of habit. You've banked with the same big 4 banks since you were 12 years old. You have their app, you know their logo. So when you want a mortgage, you go to them. You figure, I'm a loyal customer. They'll look after me. Here is the cold, hard truth. If you put all your loans with one bank, you will hit a wall. Your borrowing capacity will max out much faster than you think. In Australia, for example, the big 4 banks control about 85% of the market. They're the 800-pound gorillas. Because they are so dominant, they have strict, standardized policies. They don't need to bend over backwards for you. But there are over 400 other lending institutions out there. Small banks, credit unions, non-bank lenders. These guys are hungry. To win your business, they have to be different. They have to offer something the big guys don't. That might be a faster approval speed, a better interest rate, or most importantly for us today, more flexible lending criteria. They might calculate your income differently. They might look at your expenses differently. So, let's look at the specific levers these smaller banks can pull to help you. 1. The buffer rate game. This is a technical concept, but it is critical. It's called serviceability. When a bank calculates how much they will lend you, they take your income, subtract your debts and expenses, and figure out your surplus. But here is the kicker. They don't calculate your mortgage repayment at the actual interest rate. Let's say you are applying for a loan with an interest rate of 2.5%. The bank doesn't check if you can afford 2.5%. They add a buffer, usually around 2% or 3%, and check if you can afford the loan at 4.5% or 5.5%. They do this to stress test you. They want to ensure that if interest rates rise, you won't go bust. It lowers the bank's risk. However, not all banks use the same buffer. Some might add 2.5%, others might only add 2%. That tiny percentage difference can equate to tens of thousands of dollars in extra borrowing power. A good mortgage broker knows which banks have the lowest buffers at any given moment. They can direct you to a lender that effectively charges you less in the stress test, allowing you to borrow more. 2. Income and expense attitude. The next differentiator is how banks view your money coming in and going out. Income. Let's say you're a nurse doing shift work or a salesperson on commission. Some banks are conservative. They might only accept 80% of your overtime or bonus income because they view it as unstable. They might shade or discount that income. But other banks? They might accept 100% of that income. If you're self-employed and have only been trading for 1 year, the big banks will usually reject you because they typically want 2 years of tax returns. But smaller, specialist lenders might be happy with just 1 year of financials. Expenses. Then there's your spending. Banks will ask for 3 to 6 months of bank statements. They go through these with a fine-tooth comb. Some banks are incredibly strict. They will look at your Uber Eats habits, your Netflix subscriptions, and your gym membership, and they will classify all of that as fixed commitments. They extrapolate that spending into the future, assuming you will never stop eating takeout. Other banks take a more common-sense approach. They realize that if you had a mortgage, you'd probably stop ordering pizza 3 times a week. They aren't as tight on those discretionary expenses. Finding the bank that aligns with your specific income structure and lifestyle habits is a game changer. 3. The joint liability problem. This is a huge one for investors who are scaling up. Let's go back to that idea of buying with a partner. Suppose you and your brother buy a $1 million investment property. You split it 50/50. Logic suggests that you are responsible for $500,000 of debt, and he is responsible for $500,000. You also split the rental income 50/50. That's how we see it. That is not how most banks see it. Most banks operate on the principle of joint and several liability. They look at the loan and think, if the brother runs away to the Bahamas, who pays the mortgage? The bank wants to know that you can afford the entire $1 million debt on your own. So, when they calculate your serviceability for your next loan, they hit you with 100% of the debt, but cruelly, they often only credit you with 50% of the rental income. It destroys your borrowing capacity. However, there is a small group of lenders who don't do this. They apply common debt reducer policies. They will actually split the liability. If you own 50%, they only count 50% of the debt against you. If you're planning to build a portfolio with partners, you absolutely must find these specific lenders, or you'll get stuck after property number 1. 4. The rent vesting hack. Let's talk about a strategy called rent vesting. This is where you rent where you want to live, usually close to the city or work, and buy investment properties where you can afford. If you're a couple, say a high-income earner and a lower-income earner, you can be smart about how you structure your rental life. When the bank looks at your expenses, they look at your rent. A smart strategy is to put the residential tenancy agreement solely in the name of the lower-income earner. Why? Because it protects the borrowing power of the high-income earner. When the high-income earner goes to apply for a loan individually, some banks will look at that rental expense, and because their name isn't on the lease, they won't count that rent as a liability for them. By doing this, the high-income earner appears to have fewer expenses, boosting their capacity to borrow more for the investment. Furthermore, when you do buy that investment property, think about the ownership percentage. If you are buying jointly, the percentage split, for example, 90% to 10% or 50% to 50% can affect your future taxation and lending limits. It's a puzzle, and you need to fit the pieces together correctly. Part 4. The final guardian, credit reports. We have covered a lot of strategies, but there is one thing that can derail all of them in a heartbeat. The credit report check. Before you do anything, before you apply, before you house hunt, get a copy of your personal credit report. In Australia and many other places, your credit score is vital. I have seen so many heartbreaking cases where a client has perfect income, perfect deposit, but they get declined. Why? Because of a tiny error on their credit file. Maybe it was a phone bill from 3 years ago that they moved house and forgot to pay. Maybe it's a disputed charge they thought was resolved but wasn't. These things appear as defaults or black marks. The problem is many people don't know these marks exist until the bank rejects them. And here is the worst part. When a bank rejects you, that rejection itself will be recorded on your file. Now you have a black mark and a recent decline. It's a downward spiral. It makes it incredibly difficult to get approved by the next bank. So be proactive. Download your credit report. Check it. Ensure it is squeaky clean. If there are errors, get them fixed before you apply. You want the road to be clear so that when you apply, it's smooth sailing. Conclusion. So let's recap. The property market is tough and banks are cautious, but you have levers you can pull. Clean house. Pay down bad debt, especially car loans. Extend terms if you must. Cut the plastic. Slash those credit card limits. They are phantom debt. Hustle. Document every bit of income you can. Team up. Consider co-borrowing, but protect yourself legally. Shop smart. Don't just blindly trust the big 4 banks. Look for the smaller players with better buffers, better income recognition, and smarter policies on joint debt. Be strategic. Use rent vesting structures to your advantage. Check your score. Don't let a $50 phone bill ruin a $1 million purchase. Real estate investment isn't just about finding the right property. It's about financing the right property. It's a game of finance first, bricks and mortar second. I encourage you to keep an open mind. Look at those small lenders. Look at the non-banks. They might just be the key to building that multi-property portfolio you've been dreaming of. That's it for today's episode. I hope this gave you some clarity and maybe a bit of hope that there are ways around the computer says no hurdle. If you found this helpful, share with a friend who is struggling to get their loan approved. Thanks for listening and see you next time.